Welcome to the Jay Martin Show. My guest today is Ted Oakley, the founder of Oxbow Advisors. I love catching up with Ted, and I wanted to find out where he is allocating cash today. So that's what we talk about. As always, beneath this piece of content, there is a link where you can subscribe to my weekly newsletter. I publish every Sunday. I love writing it. I'd love to have you join the team. Here's Ted Oakley. Enjoy. Okay, guys, welcome back to the Jay Martin Show. And I'm joined once again by Ted Oakley. Ted, it's great to see you again. And thank you for making the time.
Thank you, Jay.
So before we were chatting, I fired over a couple of questions asking what you were focused on, macro, what was catching your attention. One thing you said is that, what will the extent of the decline in public company earnings and profit margins be, and how will that affect the overall market? Could I get you to expand on that thought for me a little bit?
Well, Jay, if you look at it, the street was averaging about $225 per share for the S&P 500. And we're down around, 190 or 195 or something. I mean, it's obviously a much bigger decline than the street would have it. Now they're getting, I would say they're getting scared all along and starting to drop those a little. It was 231 and it came to 228, 225. So there's some of that going on, but think about it like this. Let's just say the 190 or 195 is correct. That means that you're basically 15% overvalued in the earnings. And that also means that your multiple, which is actually pretty full right here at this level. If you look at, forward earnings in basically 17 times, that's a pretty full price. But if you go the other way and say you have a 4,000 S&P and you only have $190 of earnings, you can see that's a 21 or 22 times. So it won't stick. See, in other words, that makes it set up so that you have to decline in order people say, well, I want to make a good buy. Well, you won't make a good buy 20 times forward. You're going to have to get something that gets you back in that territory, which means that, and we thought this all along, you had a chance to come down to the low 3,000s on the S&P, which would still not put you in deep oversold territory. It would be a lot better than it is now, but that's why we use that number to look at what that way.
And what's your thoughts on investor sentiment right now relating to the market, Ted? And here's where this question comes from. Most investors that I speak to that are not professional investors, and even some that are, cannot wrap their mind around the fact that the market will rally through maybe the back half of 2023 and into 2024, as it historically has done for the last 40 years. There's been short blips or pauses in a secular bull market. The Feds come to the rescue and the market's taken off again. And it's difficult for investors to wrap their mind around the fact that the game may change. But what do you think?
We see, we sort of see two different sides to it. I think in general, Wall Street investors look for, they want this recession to come really quickly so the Fed can step in really quickly and lower rates. We don't think that'll happen, but that's what Wall Street wants. And then I think individuals, and we find this interesting, in general, okay, and we have a lot of money that comes into the firm most of the months. And it's interesting because we'll look, and most of them are, they're still invested. In other words, we don't feel like the average investor, they're sort of in a hope routine. They're like, look, we've had a year of it. It's probably going to be okay now. The Fed's going to lower here anytime, in the next 3 or 4 months. And so we'll hold through it and everything will be okay. We don't see that. We think that the Fed goes longer, so the people are going to be upset to a degree because it runs your risk up on this stuff. And I think that's where we are right now.
So when you say that you don't anticipate the recession happening quickly, what do you attribute that to? Because if media headlines would forecast this maybe to be the most anticipated recession of all time, right? Everyone's talking about this, whether we'll see a hard landing or a soft landing. But what's slowing this process down, Ted?
Well, the two things right now that are slowing it down, now, I wouldn't want anybody to get us wrong. We think we'll have a recession. Now, last year's numbers were weak because of interest rates. This year's numbers will be weak, we think, because of recession. Depends on how you want to look at it. I mean, when I said quickly, I didn't think that we don't think that the depth of recession comes in the first 2 months of the year or something like that. We just think I don't know where it is, but it's further out, second quarter, third quarter, maybe it's early next year. I don't know if it's that far out. That's hard for us to determine. However, we think it's coming, but a lot of people want it to happen like tomorrow, next week, so that the Fed can come right back in. And by the time we get to the end of the first quarter, we're off to the races.
Yeah.
But we don't see it that way. I don't think that'll happen.
And do you put any weight on China's reopening as fueling economic growth and fueling demand that may negate the recession impact?
Well, China, is going to do better by coming out. I mean, obviously, they've had some trouble. That if you just go look at that economy and what it's made of and the whole thing, I mean, they're going to have their ups and downs. I think in general, it's I just saw that this morning. Japan, China, they have the lowest birth rates they've ever had. I mean, they're not producing people.
Yes.
So that tells you that long run, that's a decline economy. Long run, because you don't have anybody stepping up and buying the product to kick it higher for the next group. And so that I wouldn't be surprised short term if some of those things happen. They pop out, and it goes up. But that's what we would think about it long term. So it'll be interesting to see coming out. But I would guess, you're going to get some firming one way or the other. I don't know how much, but you'll get some.
Have you heard Peter Zeihan talk about his expectation for both China and Russia essentially entering the final chapter? It's a pretty dramatic outlook, to be honest with you, entering the final chapter of their nations as we know them due to the demographic crisis that you just mentioned. I mean, there's in Russia more 60-year-olds than 50-year-olds, 50-year-olds and 40-year-olds, 40 than 30, et cetera, right? It's an upside down triangle, which is tough to maintain. What do you think about that?
Well, I have Peter's book, the latest. I think I may be off a little on the title, but it's the end of the world as we know it, as far as some of the global superpowers. And he makes a really good point that if you don't have natural resources, which neither one have, Russia or China, they don't have energy. Neither one have those. They have a real problem with creating enough, enough push with their own populations to get their own economy going. So, I could see where it could play out that way for sure. It's I think he mentions in there, it's like over the next 10 years or something, he thinks both of those will happen. And he's an interesting guy for sure. He's written a couple of good books.
Yeah, I mean, he's a man of high conviction, that's for sure. When he's got an idea, it seems to be an absolute truth in his mind. When you say Russia doesn't have any energy, what do you mean?
Well, natural resources is what I mean by food, farming.
Yeah.
They've got oil, but I'll tell you, if you look at it, the big oils of the U.S. and Britain been the ones that have really produced that oil for them. Well, they're not there anymore. So even though they can probably produce for a while, they don't have anything to back it up. That's a big problem in Russia. So they'll be okay as long as they can sort of keep status quo. But hey, you got to find new oil, drill for new oil. You got to have, you got to have big companies do that, and Russia doesn't have the ability to do that.
The outlook and fundamentals for the metals remains very, very strong.
Interesting. Okay. Now you touched on investors' expectation of a Fed pivot. You said you don't agree with that expectation, expressed a couple of reasons. And I could see it, CPI numbers were down in December. Do you expect them to continue to decrease and inflation to come down? And what's your take?
Jay, I think there's some point in here where we level out and it's going to get harder and harder to push it below that level.
Okay.
I can't say what it is exactly, but my guess is it's somewhere between 4 and 5. My guess is, and let's just say it's 4.5 or 5. If what they're doing does not push it, below that level, then that's going to be a problem because everybody is counting on the fact, or they think they're counting on the fact, that we're going to go back to 2. There seems to be, if you look at the 2 factors in that, and I'll just give you 2 of them, but one of them is wages. We haven't broken the wage back at all. I mean, if you go look at the numbers on unemployment that's been filed, all sorts of things have been coming out the last, there's not much movement. And there's a little bit. I don't mean to imply 0, but not much. And if you look at that, and then if you look at a lot of the input costs to businesses, there's a lot of those things haven't, some of the commodities have broken, yes, but a lot of the input costs haven't come down that much. And so that's what's going to keep inflation up.
And that's what you would watch then. You need to see some real movement in the unemployment numbers, for example, to see the Fed make
that would be, if I were a person out there, your listeners, that's one of the things I would really watch. I mean, is the unemployment rate.
Interesting.
And if it's not going up very much, then I think the Federal Reserve hangs right in there. They don't break anything down until they see that number move around on them.
So inevitably then the Fed will likely have to take things too far if they're waiting for real-time data, if they're adjusting their policy to real-time data, and then policy doesn't actually impact change for a quarter or 2, given just the lag of policy versus economic activity. Is that part of the thesis behind, us inevitably heading to a recession, if not right away in Q1, Q2 here, but eventually?
And I think your question is, are they lagging in what they're doing?
Correct.
I believe I understand it that way.
Yeah,
but they always lag. They lag up or down. And when you finally see them, and I've been around longer than most, and when you finally see them start to lower rates, the market's going to be coming down with it. And the reason it is because by that time, they're scared by that time. And they think, man, this thing is really coming apart. And that's why all of these people out there, and there's a whole group of people, they've only been around like 10, 12, 14 years, so they haven't really seen a lot of things. But if they look at the history of the Fed, they'll realize that this idea that they're going to start what they call a pivot, which I don't use that word, but are taking the rates down, it won't work. They won't do that until they actually see some damage. And when they do that, the market's headed down with it. And so that's probably a long way out there, longer than people expect anyway, I would say.
Right. Okay. So where have you allocated capital right now? Where's you talking about your portfolio structure at present?
Jay, we have 3 strategies, and we have what we call a conservative fixed income strategy, very, very conservative. And in that strategy, almost all of that paper are, we have a little bit of gold, 4%, but other than that, everything else in there is, within, 4 to 5 years or less in duration.
Okay.
People ask us a lot about, well, we don't want to try to get the bond move. Well, we think if you're getting as much interest as you're getting now on 1, 2, and 3 year paper, why would you want to go risk it on the 30-year paper when you're getting more now than the 30-year? I know the argument is when the curve goes the other way. I understand that. But you have plenty of time to make a move. That's what people forget. It's not like the whole curve moves in one day. So you've got plenty of time, but all of that is real short term. In the middle one, which is called a high income strategy, we have anything we buy in there is going to be yielding, basically 5% or more. Most of the things in there yield 5 to 10%, but they look something like this. We have, if you look at it, we have a couple of medical REITs that we think will weather the economy. We have about 3 oil and gas royalty companies. We'd rather have the royalty and the minerals rather than the producers, because we don't have to put up the capital expenditures, you see. We just get an override. We've got some gold in there too, a couple of miners. We have some gas pipelines. If you look at, Enterprise Partners and Marathon, and we've got probably 3 of those that we like a lot. Then we've got, then we go some preferreds. We like the preferreds here because they yield about 6.25, maybe 6.35. And people forget about it. These are qualified dividend preferred. So you only pay 20% tax on them. And we like that area. And we have probably, I don't know, 6 or 8 of those. And then in addition, we have about 50 to 55%, probably 55% or more that's liquid. When I say liquid, it's in the U.S. Treasury.
Okay.
By the Treasury, number one, it's 100% guaranteed. And number two, these are short-term now. We'll own some floating rates, some 3 months, 6 months, 1 year. But the other thing is, we do business. A lot of business people have sold companies all over the U.S., and so they're in different states, and the Treasury doesn't have any state income tax. People forget about that. We see them all the time go down and buy a bunch of CDs or money market or something like that, and we're like, well, why wouldn't you take 4.5% in the Treasury and not pay any state income tax on it? So that on the stock side, we're really liquid on that. We're probably 60. We have a short position, about 8% we've had for some time. But if you include that with the cash, that puts us up at, I don't know, 62% or something. That's basically bulletproof. We own companies there. Don't get me wrong. We own MasterCard, Visa, United Health, Riley Automotive. We own some good companies. We're just not at a stage where there's some really, really, really great buys yet. But we do see a lot of opportunity somewhere when all this, trades out. It can create a really great piece of opportunity, and that's where we think we'll end up.
Interesting. Yeah. So the high income fund specifically, looking at oil and gas royalties. I love that for also the inflation play, right? You're hedged against any increased cost of inputs. I look at precious metals, royalty and streaming companies for the same reason. Gold producers, can you mention names? Any names come to mind? Are you looking at?
Yeah, well, we own, just so you know, the group, how we own, if you look at the, I'll take the oil royalty first. And we own,
sure.
We own Sitio, which is STR. I know most of your people probably never heard of it, but it's a great cash flow item. Do a lot in the Permian. We have Permian Basin Trust, PBT. Now it's an oil and gas royalty trust. It's a little different, but it's nothing but the royalty side. Okay. And we've owned off and on, and we'll own it. We'll own more of it again. Texas Pacific Land, which is probably one of the more undervalued if you got right down to who owns what. On the pipeline side, you look. We own. Enterprise Product is our biggest holding. We own Plains All America. We own Magellan. That's our number 2 holding, and then we own a little bit of Marathon, which is the old Marathon, which is MPLX. All of those things are 8 or 9% yields, and then on the real estate investment trust side, we own Omega Health, which is, it can be a little controversial, but it's still we like it. Okay, it's it's 9% dividend, probably close to that. It's if you look at, we own Physicians Realty, which is DOC. It's about a 6.25, 6.5, all doctors, and it's we just want things we think can get through the other side of the valley. And then on the preferred side, your investors want to always know that you own things that are tax efficient, and we own qualified dividend. You have to ask that question if you're buying preferred. Is it a qualified dividend preferred? And that gets you the 20% tax rate.
Yes.
See, if it goes on bonds or anything else, you're going to pay 37. So you want to ask for those. We have most of the ones we have are too big to fail banks. I mean, we have Citibank, Bank of America, Wells Fargo, JP Morgan. They're all in that category. Good cash flow items, and if the bond market, if yields go down, these will trade straight up just like a bond. So we like that group. We like that group as well. And we did own Getty, which is basically convenience stores and they have some lube stores too. But it got to the high end of we just sold it this week. It got to the high end of our valuation, so we sold it.
Got it. Okay. And then in the conservative portfolio, you mentioned 4% gold. Can I ask, is that higher? Is that normal for you? Good markets, bad markets, that's typically at 4%? Or have you increased that allocation over the last year or two?
Not a lot. No, it's been about 4 in that category. Now, in the high income category, we're 6 to 7. And that's increased because we added more of some. We already had some miners, but we added more of the miners. but it's about a 50-50 split in the high income between gold and the miners. We own just gold in the conservative account.
Yeah, got it. Okay. Okay, very cool. Look, Ted, I appreciate your time. I love chatting with you and finding where you're looking, where you're paying attention, and where you're allocating capital. Thank you so much.
You bet, Jay. Happy New Year to you.
We actually need to have a damn good recession.
The Russian economy is a gas station run by the mafia.
$41 trillion has been created out of nothing.
There's a stranglehold in China on most of these resources.
The outlook and fundamentals for the metals remains very, very strong.